JC Direct this week, our final podcast for the year, and we look back at everything 2024. This is JC Direct, episode 613 for 12 December, recorded just ahead of market open. My name is Simon Brown. This podcast is brought to you by justonelap.com. I want to kick off. We did our final power hour for the year last night, which was Wednesday at Standard Bank. And it was the way we always kick off, we end the year rather. Position your portfolio for, in this case, 2025. It's a little over an hour, presented by myself. As always, I start off by checking back what I said a year ago and essentially marking myself. And then I talk commodities, politics, markets, currencies, everything. And then I put some predictions for what I think will happen next year, including some stocks, very bullish, but also some risky ones there. Justonelap.com/power hour. You will find all of those sitting there. That was the wrong music. We also had a look at the worst ETFs for 2024, and then we had a look at the best ETFs for 2024. The best list is giant and chunky. The worst list is quite small. You'll find all of that justonelap.com/ETFs. So the year is wrapping up. Tomorrow is my last working day. I'll be back again in January. Of course, we kick off January. Keith McLachlan, Mark Ashton. We will do our predictions show with them. Again, as always, we mark ourselves first. We keep it real and honest. But let's start off with this last year and where were indices for the year. So we've got the year-to-date change. We've also got the 10-year and 20-year CAGRs, compound annual growth rate. If we start in the US, the Nasdaq is up 33% year-to-date, Dow Jones up 17%, and S&P up 25.5%. Those are giant numbers. And if you go have a look at that power hour I did last night, I crunch into it. These markets are expensive. If we get 20% earnings growth in the S&P and 30% in Nasdaq, it takes them back to fair value, but only fair value. So these markets are expensive. But what really interests me is the CAGR. So let's look at a 20-year CAGR. 11.85 for Nasdaq, 8.5 for S&P, 11.75 for the 5-year, for the 10-year, and 15.7 for the Nasdaq on a 10-year CAGR. Those are solid numbers. Europe, not so good. The only red one on my screen here is France, CAC around 40, down 1.6%. The Netherlands was up over 13. Germany did really well, up 21.77%. Again, remember, Germany economy is struggling, but the market is not the economy. Your CAGR here are bleak. So Italy's 20-year CAGR is 0.7%. That is not a lot of anything whatsoever. But all of these CAGRs are low single digit. The best is Germany at 8.25. The worst is Italy at 0.7. 20-year CAGRs. Those are not great returns. Middle East is South Africa. We're up 11.33 year to date, and that number is not right. I don't know why it's showing me that bogus number, but nonetheless, we're closer to 15, and our CAGR is 10.3 over 20 years, which is not bad. 6.4 over 10 years, which is barely ahead of inflation. Over in Asia, India having a decent year, and their 20-year CAGR is 13.7. That is really chunky. Japan having a good year. Their CAGRs aren't bad either. Hong Kong has got a 10-year CAGR that is negative. That is just a horror. Australia, a 4% 20-year compound annual growth rate is not thrilling by any stretch of imagination. The point is, we had a great 2024. It almost, with some exceptions, which are basically commodities. Other than that, it pretty much didn't matter where you were invested. Bonds did well, cash did well, equities did well, gold did perfectly well. Everything had a great year. And I think if you weren't in commodities, bulk commodities, PGMs, and related stocks, if you were in any of those, then you were not having a fun time. Absolutely, you were not. And there were some big movers in the commodity space, but they kind of like the sort of stuff that we don't really actually trade. There are ways to trade it, and I'm looking, let's do this the other way around so we get the top winners at the top. In the commodity space, cocoa up 144% year to date, coffee up 70%. That kills me because those are two of my weaknesses. The only thing that's not on that list of soaring higher is whiskey. That's probably gone higher too. But what have we got? Natural gas, gold up 31.6%. The gold story continues to be bullish. I've spoken about it a lot. And in fact, gold hasn't gone, the sell-off hasn't gone as low as I thought. We've now got gold back above 2,700. And what we're seeing here is that weaponization of the dollar. We're talking around uncertainty, worries about the years ahead, geopolitical tensions, Donald Trump back in the White House. That is what is driving gold higher and will continue to drive it higher into next year. Copper up a smidgen, rhodium up a smidgen. Someone was asking me last night if rhodium's going back to 30,000. The answer is no. But then it's all on the red side, and let's do it that way around. So iron ore was down at 23%. We have uranium down. We have wheat off. Palladium down 9.6. Coal off 9.5. What else we got? Brent down 4.5. Platinum just over 4% lower, and West Texas Intermediate down almost 2%. I am not bullish on oil by any stretch of imagination. Firstly, we have the chart, which is saying, on some important levels at around that 72, 73 level, I think it can break it. Donald Trump, drill, baby, drill is basically his mantra, and that is going to see oil lower. We have oversupply going into next year. We don't have demand coming through strong, and that is going to see oil weaker. OPEC doesn't have the level of control that they used to have. It's just OPEC's days as a massive controller is just no longer there. Palladium, I mean, this is just an ugly chart. So the 3-year chart, but let's take it to a 10-year chart. It looks even worse than a 20-year chart. At some point, PGMs turn, but they haven't yet, and they're not. And I don't know when they turn, and I'm certainly not betting that it's going to happen immediately. I'm going to wait for it to turn. Platinum has basically been range-bound for about a decade. We had the pandemic sell-off, we had the post-pandemic rally, but otherwise platinum is just going sideways. The World Platinum Council will tell you that they expect deficit for the next 3 years, 25, 6, and 7, and in fact I think 28 as well, the next 4 years. And the demand destruction that we were seeing because of EVs is slightly abated because we're getting hybrids. I hear all of that. These are not new stories. They're still not responding. The thing is that the platinum miners are actually still in too good of a condition. And what I mean by that, their balance sheets are looking okay. They haven't got excessive debt. They're still profitable. There's been a few palladium shaft closures, but not very much. We need some capitulation in this space. That's what will get us really excited. At this point, it is just not the thriller at all. And then I want to have a quick look at copper. Where did my copper disappear to? There it is, HG1. Copper's a weird one because there's a massive bull case for copper. All of these vehicles need copper, these electric vehicles, batteries, all of these fancy chips that are going into AI, they all need copper. Everything needs copper. And I suppose this isn't the worst chart in a sense. It is moderately bullish. Its support is holding. But at this point in time, it's just not breaking. This is price per pound rather than per ton. But essentially, you get back to the same price. So commodities, a bleak year, absolutely a bleak year, and it's not going to change anytime soon, I suspect. And when it does, we'll jump on. In the meantime, long gold is definitely the place to be. Other than that, well, there's no great thrilling excitement. Let's go have a look at some of the economic data that's come out from South Africa, because that is intuitive. So we had a couple of data points on Wednesday. The one was our inflation rate, which went up slightly to 2.9%. But then we also had retail sales up 6.3% for October. That was really the first fully practical retail data that we've had. And I say that, two-part retail data that we've had, because yes, September, but it was still waiting to happen. man, those pandemic things are going to mess everything forever and a day. But a 6.3 number is, the previous time we had a number like that was July 22. People are spending their two-pot money. We've seen this already in many places. We saw it in the Pepcore update. We saw it in the Mr. Price update. Not for the period being covered, but they both said is that post-period end, October, November, saw strong sales. And that's exactly what we're seeing here in our retail sales. That is a massive jump higher. That is consumers who all said that they were going to use the money to pay back debt, but the indication is, maybe not. Of course, we've got the inflation data at the same time. Inflation came in quite nicely yesterday, 2.9. A thought that occurs to me, our target is 3 to 6% for inflation. At times, the central bank has targeted 6. More recently, they've targeted 4.5. Are they now maybe just targeting the 3% end of the range? That would be totally legit, right? They don't need to change the inflation target. We've got a 3 to 6% range. They might just target 2.9. It does mean, because unfortunately we're not getting the rate cuts that we had been hoping for. Where's Prime? There's Prime. We're just not getting the rate cuts that we had been hoping for. And what that then gives us, why does that look so terribly, terribly ugly? There we go, better looking chart. We've had some cuts. We've had 2 of them. 0.25%. I think next year we might get 3 cuts, take us down prime to 10.5. I don't think we're going to go much beyond that. The big question is can we get GDP going? I really do think 2% next year is very doable. This two-pot money is really being spent. Expectations were for about 40 to 60 billion to be withdrawn. An early November number said we were already at 35 billion. Alexander Forbes says they were seeing withdrawals twice what was expected, and that data shows that it's been spent. We also have load shedding gone, which means that suddenly we've got power. The Reserve Bank said that was easily taking 1% off our GDP. I think two-pot and a load shedding alone can add 1.5%. Then, of course, there's grey listing, big meeting in June. Hopefully we get off that list. But certainly, For equity markets, I am bullish for next year. We haven't seen the foreigners start buying yet. For commodities, I am bullish gold, but not the other commodities. And for global indices, the US, they're expensive, is the honest answer. I think that in the early parts of the Trump presidency, we might see some chronic volatility, and I think we need about a 20% sell-off. Maybe we can get away with 10%, kind of reset. I think they can close the year green, but I think that after they've closed the year, they've sold off a bit, is going to be the first part of that. Let's look at some local equity, because there certainly has been some movers in local equity. Mr. Price, you beauty. So I hold it. I haven't done the 95% return. That is the total return, so it includes dividends, because I bought it in January when it was already starting to move. A 10-year price change, 10-year CAGR on Mr. Price of only 3.1%. That is a staggering number. If we zoom out 10 years, basically it has done some 30%. It's gone up around 3% over the period. Not great. And you can see, I was buying back here at about the 160. Nice entry points going through. The story here was quite simple. A consumer that was looking better, two-pot money coming. Mr. Price, the other one I got was Fashini Group. Banks, Capitec up 66, Nedbank up 44, some gold miners coming through, Discovery up 37. Folks, don't worry about NHI, it's just not coming. MultiChoice, that delisting, of course, there. British American Tobacco, I got to say, surprises me, although their long-term price changes are not particularly thrilling. Anglo American, that makes Growth Point. Here's a weird one. Growth Point up 25%, but it's giving me a negative 10-year CAGR. Is that even possible, or am I getting horrible-looking data? Because a 10-year negative CAGR on Growth Point, so no. Why is my data so ugly? I need to dig into that, but I'm not going to do that quite now. So it is positive over 10 years, but not by a heck of a lot by any. I think they do calendar years. That's why. They don't do the exact year, so it is calendar. Clicks is up there as well. I like clicks. It's not too expensive. But a lot of these stocks, and let's have a look at Mr. Price, not the chart. Let's go have a look at the snapshot, the overview. What we've got here is a forward PE of 19 and a mean PE of the last decade of 8.5. So Mr. Price is not, we could say it's slightly expensive, not chronically expensive. And it's, it's run hard. I hold it and I am continuing to hold it. What are our analysts, experts? Surely it's at the top end of, so high end of price targets 238, average is 270, lows 197. There's actually 2 sells sitting in here. I don't think Mr. Price is terrifyingly expensive. I don't think it's cheap. Would I be buying it at this point? I would wait for some weakness, but otherwise I'm happy holding Mr. Price. And Fashini's my other in this space here. Sasol, down 50%. This is probably, so there are 2 types of people out there in Sasol. There are those who are saying that they love it, and then there's the rest of us who are saying, why do you love something that's just going down? It is negative over 10 years. It's probably negative over 20. Okay, it's slightly positive over 20. The thing with Sasol is at some point it changes. It's not going bust, okay? So at some point this trend starts going higher. But when? And my view is quite simple. I will wait for that to start happening. Someone said to me recently, this is a 300 Rand stock. Okay, it's the 300 Rand stock. I will buy it at 150 and double my money. I'm not a buyer of Sasol at this point in time. Thank you, but no thank you. Other losers, Kumba, no surprises. Anglo Platinum, no surprise. MTN, I do not like the telcos. I don't think there's anything. Interestingly, I was chatting with someone on my Money Web Now show, and they were saying they like the subsidiaries. You can go and buy MTN Rwanda, Ghana, Nigeria. They like those. They don't particularly like MTN home country, South Africa, because you get that hit from the hit from the currency moves. Interestingly, Goldfields, slightly green for the year after Rand was flying, but not much red here. Remgro, Exara, Woolies, Aspen, not a lot of red for the year. Glencore, Mondi, BHP, none of those massively surprising. It hasn't been a bad year at all. And if we go look at the mid-cap space, pulling up my table, Fortress, Yowza, Mr. Price, no surprises. Outsurance, yes, Fashini, Pepcore doing great. Truers, Momentum, Harmony, Tiger, you can see all the stocks there. AVI, again, Nedbank, Pick and Pay doing well. 2 good listings this year. We Buy Cars, Boxer, both quality. I particularly like We Buy Cars. If it would just collapse in price just a little bit for me so that I can go and buy myself some. Monterac down. I don't know enough about that. Aspen should be a top stock. It is not a top stock. I don't, you know what I think it is? Lots of promises, no deliveries, negative over 10 years. It breaks out, it comes back. It just is no longer the stock it used to be when it was back, $400 back in 2015. It has fundamentally moved on, and there's nothing about it that particularly excites me. Distel is now gone. Remgro, really horror returns. Netcare, not particularly thrilling returns either. It's been a year. It's been an absolutely great year in the equity markets. I remain bullish for SA Inc. Go watch the Power Hour video for details as to especially where and why and how. But look, there are risks out there heading into next year. Absolutely there are. Valuations, Trump, wars, and so the list goes on. But I do think that South Africa can have a good year. Of course, if the whole world goes to hell in a handbasket, then frankly, we're going to follow them as well. The big question then is Rand. So the big issue on Rand, of course, as always, is DXY. Let me go look at the DXY and let me pull up the dollar as well. DXY, which is the dollar index. Show me chart. Thank you. It is at the top of the range. When it was last back at the bottom of the range here in early October, the Rand was at 1704. It's been up to around 1830 since then. It's currently trading around 1760. We'll look at that chart in a second. And where does the dollar index go from here? Does it break higher? Does it consolidate? Does it go lower? I'm expecting it to come back lower, and that takes the Rand easy to a 1680 level. Let's see where it is right now. It's about, as I said, 1760. There is our rand, 1766. 17 is a big number in its life, but I really do think that we can move this and get it down to 1680 in the shorter term, in the next couple of 2, 3, 6 months, and then longer term. I still think 1550 is very, very possible, and ultimately even lower. If we could get China going, and if we could get a bull market in commodities, then the rand is going to go back to 12. But we're not getting China going so far, and we don't have a bull market in commodities yet either. JSE is a registered trademark of the JSE Limited. JSE Direct is an independent broadcast and is not endorsed or affiliated with, nor has it been authorized or otherwise approved by JSE Limited. The views expressed in this program are solely those of the presenter and do not necessarily reflect the views of JSE Limited. That's it for the year. Then we are officially done. As I said, we will be back in January. Huge thanks to everyone who listens every week. Remember, we're also now on YouTube, so you can go and watch what I'm saying as much as you can listen. The audio is always there. The video is just an add-on. You can pick whichever you like. That's fine. And of course, we publish it every Thursday. We had some misses this year due to a bunch of reasons. Actually, I was going to say weekly podcast is hard, but I also do a daily one. But with the daily one, I have a whole team around me. The weekly, it's just pretty much me. But everyone out there, really appreciate the views and the listens and the comments and the feedback over the year. We will be back next year. You all have a great holiday if you are taking one. If not, thank you. Somebody has to keep this economy working during the holiday period. My name is Simon. We'll chat again next year. Until then, look after yourself. If you can, look after somebody else as well.